A growth company benchmark is how many percent? 5, 10, 15, 20 or more. You use revenue or profit or free cash flow. And then the example, you buy Microsoft. How do you gauge if it is right price? By feeling PE history, compare intrinsic value. If intrinsic value can show a live calculations of your method. I think there are quite a number of questions packed together here. Let me go into it one by one, and later I will give some example using Microsoft to just to illustrate the thought process. Okay, so the first one asking like what is the growth company, what is the percentage, right? First one I want to clarify is that actually when people talk about growth companies, right, actually like you ask different people, when they speak about growth companies, they have their own interpretations of what is growth company. Some people say Apple is a growth company. I don't think so, because I think that companies like Apple, Microsoft, these are actually like old companies, right? So they have been established like for many years already, like decades. So they are definitely not growth companies. So when you speak about like high growth companies, usually these are companies that at least, right, they should grow at like 20, 25, 30%. Anything lesser than 15%, right, I won't consider it as a growth companies. But sometimes people tend to, like combine, or they mix growth company and tech companies, and they thought that all tech companies are growth companies. I don't think so. Usually that isn't the case. You can actually plot like a 2x2 quadrants, right? There are, tech companies that already went past their growth stage, whereby there's already like, stagnant or mature companies. And there's also companies that is not tech companies, but they are growing very fast. So you need to differentiate between these two. And this one, I don't think you need a lot of like judgment to tell whether a company is growth company or not. What you can do, right, is you just look at their recent historical growth. And from the historical growth, you can tell whether they are like high growth companies, right? Like in Apple and Microsoft. Later we'll get into the numbers, right? You notice that actually their growth isn't like fantastic, isn't like 30% kind of growth, right? Another good companies, good example is Tesla. Definitely when I think they're going to release their delivery numbers soon, and you can see that just quarter on quarter growth, right, is like quite a high one. Like even if one quarter you can grow at 5%, right, or above 5%, that's like 20% per year, right? So above 20%, yes, it's decent growth rate, but those ultra or high growth run, usually people are looking for like 30, 40, 50%. So that's the category on like what is so-called like the high growth companies. So let's get to the second one about the right pricing. Like should we look at the PE, or should we look at the intrinsic value, and so on, right? So I think this question is also quite interesting, because I think that, let's say you need to understand like different type of companies, right? You should use different type of valuation, and some valuation metrics, right, really is useless depending on the situations. I give you some example, right? For companies like Microsoft, right? Yes, actually you don't need to do complicated DCF, because they already at the mature stage. Companies that's already mature, right? You can see that their growth rate like is like not super high, and then their margin also is kind of stable, and then their free cash flow margin also about stable. If that's the case, right, everything is more or less stable, right? Actually, you don't have to do like discounted cash flow. Basically, you can just see what is their like historical PE or historical price over free cash flow, or EV over EBITDA. That doesn't really matter, because all these valuation metrics, right, they should be fairly stable over time, because their growth rate isn't super high, right? So things should stabilize already, meaning that companies that they're already like, stable, already mature, right? If their net margin is 10%, you shouldn't expect their net margins to go to 10, 20% like over time, right? Because there's no more scaling, so cause there's no more way for them to squeeze higher profit margin, right? Because they already matured. So you can just look at historical valuation, and just from the chart you can gauge whether they are expensive or not. And you can say, okay, for example, like let's say Microsoft, right? We can look at some example, right? Let's say Microsoft. You can go to, let's say, their metrics valuation. If we just look at their PE, right? No need to look at the price. And then you can look at here, if you're like me, we didn't subscribe to Seeking Alpha Premium, right? At most we can view 5 year, right? So this is the PE of the companies. You can see like over the past quite like few years, right? Their PE also didn't like go up a lot or decrease a lot, right? It's fairly stable. So just from this chart alone, right, you can say, okay, maybe if their PE dropped to a range of about 25, that's actually considered relatively cheap. And if it is approaching, let's say 40, it is considered like more expensive. So average, you can call it like, let's say about 30. 30 will be more like a reasonable level, right? You can do this kind of like so-called valuation if the company is already like mature. But if the companies is still high growing, right? Let's say Tesla. I think Tesla was quite popular one, right? So you can look at their metrics, valuation, PE. You see, it doesn't make sense for you to look at the PE for Tesla because in the past, right, when they are not making any profits, right, when you have a negative PE, it doesn't make sense. And then after they turn profitable, but their earning is still very low. So whatever price divided by numbers that is very low, close to zero, you get like a highly inflated numbers. You get like PE of about 1,000. In this case, right, PE isn't very useful because we know that as the company continue to grow their revenue, continue to grow their profits, of course, their PE, assuming that the price stay at the same level, right, or relatively unchanged, right, as your earnings continue to double and double, your PE numbers will drop very significantly. As you can see here, from a PE of 1,000, they drop very fast to 600 and then 300 and then drops to 100, continue to drop. This should be expected because as your earning grow, right, then your PE should drop. But whether it makes sense to pay a PE of, let's say, 300 back in 2022, it really depends on what's the level of growth that you want to put into your assumption. So that, in that case, right, DCF will be a lot more useful. So just want to make these distinctions is that whether you use PE or not, you really need to look at whether the company is high growth or not, or whether, let's say, a situation where the company is currently not making money because of certain one-off issues. Let's call it like the net margin is like negative 5%, right? But you expect the net margin to go up to 0%, 5% in, let's say, 3 years' time. In that case, DCF also useful because you want to incorporate in your assumptions that the margin will improve. Those scenarios, right, you cannot really just compare the historical PE and conclude whether they are undervalued or overvalued. The only historical PE, the only case where historical PE is useful is when things are stable, like in terms of their growth, in terms of their margin, those are very stable. Then you can just keep it simple and just look at the PE chart. Okay, so that's just a summary of like what kind of situations to use, what kind of method. Then let's go into Microsoft. I think the question here is asking like in Microsoft case, what method should we use, right? I know for those who are very, more inclined to use DCF or inclined to look at the valuations, you might just quickly jump to the conclusion like, let's go and calculate the intrinsic value. Let's try to understand like, okay, whether the company is undervalued or not. This is the typical, what we call the value investor, right? You say, let's do the calculations. If the DCF or the intrinsic value is 200, the price is 300, then maybe I just short sell the company. Or if it is undervalued, I just buy, right? I mean, this is very typical. But I would say, if you follow my approach, right, I would say, yes, I personally, I'm a person that is like inclined to look at the numbers. But sometimes I think we need to take a pause to just say, okay, let's don't like jump too fast into the calculation. Let's spend some time to understand the business first, to understand the qualitative part of the business before we get into the intrinsic value calculations. Because when you are at the DCF level, right, you still need to come up with some assumptions, like what's the growth rate, what's the margin, and so on. And you need to understand the quality of business in order to really come up with those like informed assumptions, right? So you cannot bypass everything, straight away jump to the calculations. If not, you just throw in like rubbish assumptions and then rubbish in, rubbish out, right? So that's why I say don't jump too fast into the DCF calculations. Take some time to look at the business first. So come back to Microsoft example, right? I'll say first things, right? In like a individual companies valuation or like due diligence, right? The first thing you need to understand is what is the business model. Basically, business model is that you want to understand what are the products or services sold by the company. How do they actually make money? The how do they make money actually is very important because, say for example, in Meta case, right, or Facebook, right, people who don't understand the company might try to see it from the customer's perspective. They might say, oh, Facebook is an old platform. Facebook is not, the UI is bad, blah, 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 all these things. But actually, you don't understand because whether the company make money or not doesn't really matter if you look at things from customer, because the real customer is not the user. The real customer are the advertiser. Basically, they are selling ads to the customer, right? So they can do a lot of like R&D improvement just to help the advertiser. Then it's very easy for them to run the sales, because their business model is not about like creating social network. It's about selling ads to the advertisers. So this one, how the business make money, is very important things, because if you get these things right, if you get these things wrong, right, then the later part will be very tough now. So that's some things to begin with now. So in Microsoft case, at least you need to understand, okay, their business include all these like Microsoft Cloud, the Azure business, they have devices, they have the Xbox gaming business, and then they have their Windows and Office, all this licensing, and then they have all the games, apps, the entire ecosystem. This, how all this piece together, right? This is their business model, and basically what are their product and services that they're selling. Actually, in Microsoft case, right, they are software business, and they are actually quite wide in the sense of from the SaaS level until the infrastructure level, the Azure infrastructure, right? All this, they participate in all these different areas. That's why their business is actually very vast. And then when it comes to where they drive their business, right, like in terms of their revenue, right, you can pull up all these charts, right? Actually, all this, you just do Google search, just type like revenue breakdown of Microsoft, right? Then click on the image, you can see all this like very pretty image for you to help you visualize the business now. In Microsoft case, you can see that the Azure is one big part, the Windows is one big part, their Microsoft Office like Excel, PowerPoint, all these are one big part. Then there are all other smaller ones, for example, like Bing, gaming business, LinkedIn, their devices like the Surface, enterprise services, and all these are smaller. The bigger one are all these Office, Windows, and Azure. And Azure is the high growth one. So this one gives you like an overall view of the company. Like at least you need to know like all these big part, because if you understand the big, like the big business lines like Office and Windows, right? And if you don't like the big part, right? Say for example, you think that, okay, actually Microsoft Office is actually dying down. Yeah. In that scenario, right, you might want to stay away already, because they can screw up the small one. For example, like they want to try to incorporate all this like ChatGPT. They could screw up here, right, in terms of like not getting as much ad revenues, right? But it's okay if it is a small one. But let's say if the big one, for example, the Office, the Windows, if all these big platforms screw up, basically the business will be heavily affected. So you want to know like which are the important one. The reason I mentioned about this is because those people who don't do due diligence, right, they don't know what is important, what is not important. Again, I will bring out Meta as an example, right? I still remember that there's people who say, okay, do I want to buy Meta as an investment? So they will say, I will invest in Meta if their VR headset is getting better. But actually, if you plot the same chart for Meta, right, you notice that actually the VR headset, right, is actually very, very tiny. It's almost a non-existent one. It's actually their ads revenue that is driving their revenues. So their advertising. So if you look at the not important one, like call it like the VR headset for Meta, then actually you are missing the point, right? Because whether the companies can make money or not, it really depends on their, like the big revenue drivers. And each companies will have their big revenue drivers. For example, like in Apple case, it will be their iPhone sales. In Google, it will be, like their search advertising plus YouTube. These are the big one. So in Meta case, it will be their advertising, including all the IG, Facebook, and so on. So different companies, different main businesses, and you need to understand the main one. The smaller one, I would say not so important. But look at those like big revenue drivers lah. Then of course these are like high level overview, right? Just for you to like you close eyes after you do the research, at least you remember these few big pieces. But of course, if you want to go into details, you can go to like some like online resources and try to pull out their past financial, because first thing, when we invest into one company, you want to know whether the management is able to execute or not. And sometimes it's very tough to know whether the management is good or bad. Like especially we from the external, we are not working with the companies, right? It's very hard for us to judge whether they have good culture. Although those are very important, it's just that it's very hard to judge. But one thing that is clear is that if the companies, the management is good, right, they were able to execute their plan and they are able to bring in more revenue and bring in more profits over time. Like, I'm not saying about like just look at the past 1 year. We should look at over the past 3, 5, and preferably even longer, right? 3, 5 years or 10 years, and see whether the revenues, are they growing or not? Profit margin, are they growing or are they stable or not? These kind of situations, so that you can understand whether the business, is it like a good business mode? Do they have business mode? Do they have good management able to execute? Are all those metrics looks good or not? So you can pull up, like tables like this from website like ROIC.ai, and you can see their revenue per share, is it growing or not? In this case, there's some, like small chart here, right? You can see that, okay, revenue growing, earning growing, free cash flow growing, dividend per share growing, Capex, of course, they have to invest, right? Capex also growing. So, and their shares, outstanding shares actually reduced slightly over time. So you can have a good overview of the companies by just looking table like this, and just have a sense. I would say pay attention to the chart if you are not a like numbers person. Like you look at this, you get dizzy already, right? Then I would say just cross out all these numbers. Just look at the chart alone can give you some ideas. I'll pull out the important ones just for you to like have an overview. So you can look at their free cash flow, right? From early 2000 until now, you can see like it's like parabolics going up. So good management. If business is bad, management is bad, there's no way they can pull out this kind of like free cash flow growth, right? Then second one, this is about the valuation, price over free cash flow. This later will be used in the valuations. So you can see in the past when the companies, when Satya Nadella haven't become the CEO, right? The companies was actually failing. They tried to compete on mobile phones. Actually, they failed. So the company growth actually slowed down, and then their price over free cash flow also dropping from .com bust in 2000 to about 2012 and 2014. Then after that, after Satya Nadella came in, he really execute on his strategy, like the mobile first, cloud first. So they have recovered very well since like 2014. So, but what kind of valuation to pay? That's the questions that really depends on individual investors. But as of now, just be aware that if you are buying Microsoft today, you are paying like 44 times over free cash flow. This is not a small, like a low valuation. This is actually quite a rich valuation. And you can just look back, right? Like this is COVID crash in 2020, right? This one, they dropped to about 26. But just early 2022, they also dropped to about 26. So you can see that let's call it like 26 times free cash flow is considered like relatively cheap, but 44 times considered definitely expensive. So you might say a fair value could be in between, could be like 30 or 35 or 40. 40 is a bit high. I mean, just looking at the chart, you can tell. But this one, there's no science to it. It's more like based on your own judgment on what kind of price level that you are willing to pay. Because if you set it too high, right, meaning that you might buy it at that there's no margin of safety. But if you set it too low, you say, actually even 26 is too high. I'm happy to buy at 20x, right? Fine, you can make that kind of assessment, but that also means that the price may not come to the level that you like, and you might just look at the company, the share price continue to just go ahead without you on board now. So that's a trade-off that you are making. Again, similar level. If you look at PE, also same. You can see when they are low, they could be about 24x PE or 37 or 40 times when they are expensive. So looking at this, right, I would say definitely if you are buying now, it is not cheap. No? But whether it is like crazy bubble, I also don't think it's like bubble territory. So at least just plot the chart alone, I think it's quite helpful to give you some sense already. Again, I need to caveat this kind of chart plotting and make assessments doesn't really work for those high growth companies and doesn't work for companies that is not making money now or just starting to make monies and haven't really matured in terms of their achieving a stable kind of like margin, profit margin. Okay. The other one that you can cross check is that, sometimes they are outsides, right? They are, like informations to inform you about what kind of growth rate that you should target. Because when you look at all this, right, this chart, all these are actually historical. But when it comes to future, right, sometimes it's like, okay, I can, like in NVIDIA case, we can throw in what, like they can grow 50% for the next 5 years. You can throw in any numbers, right? But those numbers are just, like just speculations. Like nobody can know like what kind of growth they're able to go for, like can able to achieve over the next 3 to 5 years, right? And at most, I think companies, they can guide about like, 1 year ahead. But longer than one year is very tough because you don't know what kind of environment, you don't know about the competitions. Basically, it's very hard. But sometimes there are numbers that thrown out by maybe some other analysts, sometimes by the management, that you can, I would say, use it to serve as a reference, not to say that this number will be the right numbers, just serve as a reference. In this case, right, there's this court filing from Microsoft, and they actually set their internal goal, right, at 500 billions of revenue by 2030. 500 billions to me, I don't think that's really that excessive, given that, to now it's like 2023. So 2030 is like still 7 years ahead. And currently their revenues is already at about 200 billions. So we are talking about like double, it's like more than doubling of the size of the revenue, but given 7 years, right? So to me, that's like sounds reasonable. Later you can look at the examples in the DCF. So let's jump to the DCF calculations. So I think first step, right, in DCF, right, is that you want to collect some informations, because historical numbers, although it's historical, but still quite useful when it comes to inform your assumptions for future, like how much you want to incorporate in, right? So usually I will start with like just pull in the informations. Like in this case, right, this one I just take from macro trends and then just put in here. And then just from the revenue, this is operating income, net income, and then free cash flow, try to calculate these are the numbers. And then from here, I try to see, okay, what's their, historical growth rate. So just look at past 5 years, right? They've been growing at 14%, 13%, 17%, 18%. This is the past 5 years growth rate. And then in terms of their operating margin, net margin, free cash flow margin, just look at these numbers, right? I would just say my observation is that whatever net margin that they're able to generate, right, their free cash flow margin is about the same. You can look at the average 5 years, right? Gross operating margin is slightly higher, but look at this net margin, 30%. Free cash flow margin also about 30%. What this means is that for every $1 the company take in, 30% actually go into their profit margin and also become like flow into their free cash flow. So I think this is a good thing, because 30% for a free cash flow margin is actually quite high. It's actually quite high. And usually, right, these are software companies that are able to generate this kind of like net margin. If you look at hardware business, right, it's very rare to see companies that can pull in, this kind of level of net margin. Because usually, like cost of goods sold is already like big, huge portion already after you pay out all this, like, all the other expenses, right? Like SG&A and so on. Usually you are left with like, like between 5 to 15%. Hardware business usually is this range, but software companies, because there's like some, like really good moats, right? So the companies really have good pricing power. For example, like they can just increase their price. like all these big companies, they're not going to their customer, basically. They are not going to switch from Windows to some other operating system, right? It's very costly to do this kind of switch. That's why they just suck thumb and just continue to pay Microsoft to get the license for Windows now. And also some other, like all the Microsoft Office, Excel, PowerPoint, all this software. So it's really good numbers here. And the other good thing is they are fairly stable. You can see it's not like fluctuate hugely from year to year, right? You can just compare against some other companies where during bad time, they have to cut their prices to compete, to grab the market share. So you can see that their margin is more volatile. In Microsoft situations, they are relatively stable. Okay. So this one I just invert lah. I just want to put from 2009 to 2022. Their current revenue is about, actually you just look at past 12 months, right? These are the number. Past 4 quarter is actually $207 billion, which serve as my base in year 0. So this is the revenue. Let's come back here. This is the revenue. And similarly, I'll just project the revenue. And from the revenue, I just multiply by the free cash flow margin and I try to project the free cash flow. Basically, because this one, I just keep it simple. I just assume a flat 30% free cash flow margin, right? I don't expect them to increase or drop in the future. And revenue, I just assume that they are growing at this level, 16%, 15, 14, 13, 12, 12, 12. This kind of growth rate. And actually, if you look at the numbers here, right, I play around with these numbers so that I end up with about 500 billions at year 7, which is 2030. Basically, this is the growth rate. This is the growth rate. This is their future revenue. And from future revenue multiplied by the free cash flow margin, I get the free cash flow here. Basically, that's it. This is the future free cash flow. And what is driving the valuations? There are a few more assumptions that we need. Because at the end of year 7, you need to assume that, okay, like let's say this company is sold at year 7, what kind of exit multiple that, like other investors are willing to pay? Because currently, as you remember just now, the slide that I show, right, their price over free cash flow is about 44 times. But comes to here, what is the exit multiple that you want to assume? Because you assume that you buy it at 44 times. Let's say you say, when I exit, it's probably be 20, right? Meaning that the price over free cash flow, although the free cash flow is growing, but the price over free cash flow actually drop, right? So it will hit your returns, right? So this one, depending on how aggressive you are, I think putting in 44x to me is too aggressive. You are essentially betting on the investor are always willing to pay this kind of high price over free cash flow, this kind of high valuations. So to me, I think just put an average one about 30. If you want to be more conservative, you can of course put like 25 here or even 20, really up to you, right? And come up with your own valuations. Let's put 25 now, okay? Be a bit more conservative here. So after you have the exit multiple, this formula here is to say, okay, whatever free cash flow that you have at year 7, right? Because I'm putting on this cell here, I just roll it by another 10% for the discounting. And then I just multiply it by 25x now. So 150 times 1.1 times 25, I get like 4 trillion here at year 8. And then basically this is my cash flow stream. I just discount back intrinsic value. You can look at the formula. It's just like net present value at 10%. And then just this stream of cash flow, you get something like 2.4 billions. And currently their number of shares is 7540. I think this is in millions. After you divide, then you get like fair value of 322. And current price is about 340s. Based on these assumptions, it is like fairly valued. It's not that different. But if you are a bit more aggressive, you put 30 here, actually you might say actually the fair value is like 374 and the company is still undervalued by 9%. Usually undervalued by 9% or overvalued by 10%, this kind of level, I would say is considered fairly valued. You would say it's undervalued when you can get, something like 20, 30, 40% kind of discount versus current price. Or if it is overvalued, it should be like more than 30%. Because between, call it like that plus minus 10 to 15%, right? I would consider this as like, fairly valued. Because ultimately, all this intrinsic value, right, is still very depending on the assumptions. And we we as the investors, right, we don't know whether they're able to generate 16, 15% in the future. It could be higher, it could be lower, right? So as you change all this number, right, let's say this number is not 16, but 12%, right? You change already, all this number will be different, right? So there's like what we call the error, like the error of margin, not error, margin of error that is for each of these assumptions. And all these assumptions, there are so many assumptions, right? And each of them, right, could be wrong. Like the free cash flow margin could be, you know, like they could be like higher or lower than 30%. So you see, even the historical is not like flat, right? It could be like, you know, as low as, call it like 28, or it could be as high as 32. As you change all these assumptions and change the growth assumption and try out with different discount rate, you might say actually 10% is just like S&P 500 returns. If I invest in individual companies, I'm expecting higher return. I could be demanding like, let's call it like 12% or 15%, right? You can put in different numbers here. And you will notice that actually if I demand a 15% return, right? The share price, the fair value should be about 270. It shouldn't be like, you know, as high as 340, right? Then you can say, okay, it's like still like, you know, overvalued. You think the intrinsic value should be lower because I'm demanding a higher returns. So all this, right, is basically like just still come back to the, you know, garbage in, garbage out, right? It's like I'll say all this assumption is just a way for you to incorporate your own assumption, because you might say, I look at the value here, today's price it is like how much? 340, right? I want to have a sense of whether this 340, whether it's expensive or not. I need to put in my own assumptions, my best case assumptions, right? Best estimate. Then compare against the actual valuation and see whether what kind of growth rate and margin that has been priced into the valuations or the price of the company. And from there, you can assess whether the companies are overvalued or undervalued. Again, don't treat this as like a single number. You should treat it as like a range. Like you can put in a bear case, like let's assume a lower growth assumption here, and then like lower free cash flow margin, then try to come up with a number, and then put in a bullish one and look at the range, right? So that you have a feel on whether the companies, they should worth how much. Ultimately, the valuation of the company, right, still need to come back to all these like fundamentals numbers, their financials. Come back to financial means that you should look at their revenue, you should look at their free cash flow, how much free cash flow they're able to generate. I think these are the most basic one already. Of course, this can be used like in Microsoft case, or you can put in Apple also same. I think this will be very simple. But if you use it on other companies, like those high growth companies, their current margin could be, you know, like let's say negative 5%. But you think that this negative 5%, right, can go to 20% over 5 years period. Then you can just put in here like from negative 5 become 0, become 5, 10, 15. You can put your own assumptions, right? But you need to know that once you put in like you're assuming that the margin will increase, then you can come up with a valuation to say, oh, this company, although today's price is $10, I think they are worth $20. But you need to be aware that they are only worth $20 if they are able to improve their margin at least to the level that you put into your assumptions now. Because if their margins doesn't improve, they start at 0, right? Basically, even the price is a lot lower, they are still overvalued, you know? So I would say, once you expand your DCF model to incorporate more variables, you are more flexible to change their calculations and come up with the free cash flow. But that also means that more assumptions means that you tend to be, you know, like wrong assumptions now, because we want to keep the model as simple as possible so that we can focus on the most important items. To me, the most important one will be their revenue and their free cash flow margin. This free cash flow margin, I think you can see, right? I put it as free cash flow margin. Actually, you can just put in as a net margin. Doesn't really matter. This is the case where the net margin and free cash flow margin is very close. For certain companies, this net margin and their free cash flow margin is very different. I'll give one example, which is TSMC. TSMC, right, their gross margin, net margins all look super good, but their free cash flow margin is not as good. The reason is because this is a company that they have to spend a lot when it comes to their capital expenditure. They need to build fabs. They need to put money buying all this equipment and so on. So all this will actually hit into their free cash flow margin. So when you do a DCF and you put in the DCF on free cash flow, right, you notice that actually their free cash flow is currently very low and probably it's not going to pick up that fast because they are still investing heavily into their fabs and their R&D. So you will notice that their intrinsic value using the free cash flow margin will see the true picture, which is that the company isn't that undervalued. Whereas if you just look at their net margin, right, you assume that every dollars of net income is equal to free cash flow, right? You just look at their PE, right? Basically, their PE is very, very low because really, if you look at their past financial, they're able to generate tons of profit, but the profits doesn't flow to free cash flow because of the reinvestment. So again, depending how many variables you want to incorporate in and which one to use, I would say you need to understand the business model first. Then from the business model, you can understand their financial, which one is more important. And then from there, you pick the one that you think that is important and then come up with your assumptions and then project the metrics that you want to see and then just do a discounting. You can discount free cash flow, you can discount net income, you can even discount dividend, doesn't really matter, right? So after you discount all these, basically come back to the intrinsic value calculations, compare against the price and judge whether they are overvalued or undervalued. Okay, I will stop here. That's all on the Microsoft DCF. I hope that this is an illustration. I try to keep it simple so that everyone watching can digest all these informations here. Of course, if you get into other more complicated companies, things can get complicated. I will prefer a simpler approach than a complicated one. That's my preference. To me, all this is just to let you have a feel and not to come up with the magic number, right? So I think that's my way of like investing. Let's go to the Slido Q&A. Thanks a lot to everyone sharing your questions here. But before we start, I need to say that for questions like, some people ask questions about YCX. I know YCX has been very vocal in the group, giving good sharings. But let's say if the questions is like really asking him, right, I would say I'll pass so that we can focus on the others one. And when YCX is around in future TCSS session, then of course we can bring up the questions and ask him again now. Okay, so that's just set that up front first. Okay, let me read out the first questions. For my Windows Dell laptop, when battery is failing, can I easily buy a replacement battery from SimLim and change myself? For Mac, will it be the same? I would say, I think we had some discussion in a chat group also, right? But I'll just give a general advice here. So if your devices, right, they are still under warranty, of course, you want to bring to the authorized reseller just to ask them to diagnose for you. And because sometimes if things are under warranty, you don't have to pay to change the components, right? So depending, first thing is to check whether it is still under warranty or not. If still under warranty, go to the authorized one. If it's already like quite old, like that it's no longer under warranty, then I would say actually you go to SimLim. You can just ask around whether they can diagnose for you and check what is the situations. But just remember, after you bring all your devices to the like all this non-authorized one, right? If let's say they screw up your component, or let's say if after you change some component, the device work poorly, I think those are the risks that you are taking. But if you bring to the authorized one, of course, there's some level of standard when it comes to the service, right? So that's like you pay extra for that extra level of warrant assurance. But I would say when the device is like quite old and you just want to salvage it and you want to use it for quite like another 1 or 2 years, then bring to all these places. As long as they look at the situation and they say, okay, I am able to fix it for you, then so be it. Let them fix it for you. Try to save money. I can see the results. Save all this money, especially if it is old devices. But everyone have their own preference. I wouldn't say I wouldn't say which is the right approach. Really up to you. I personally, I don't have like a Mac. I never use Mac. I always use Windows. So but I mean, doesn't really matter lah. If they know the situation, they can fix it for you. I think it's fine. YCX seems like the most knowledgeable guru in the group, can share what he reads and watch. Also, how he finds the time to do this huge amount of reading or watching. This one I will give it a pass so that he can explain this when he's back or joining the session. Hey, YCX is here. You YCX, you want to comment on this?
Anyhow read lah.
Well, you don't want to like elaborate a bit like what kind of websites, what kind of, I know you read a lot on like all the Wall Street bets, this kind of resources, right? Forums, right? Not so much on the mainstream one, right?
I do read a lot of mainstream. It's just that I always, after I read, I will look for, I'll think a bit more before I read the second thing or whatever I look up for it lah. That means, yeah, because I don't really believe everything I read, so I just always read other things to see and do some counterpoint research and things. So it's usually like that. That's why you can also see that. I mean, that's why my feed for like Twitter, for example, is a lot of that means like counterpoints. That means I don't just follow one particular group, but I kind of like have multiple differing viewpoints that I follow. Like that's one. Then for like because sometimes I do a lot of reading on the desktop, right? Then when I read on the desktop, I usually do not have any recommendations turned on. So, or rather I have recommendations turned on, but the recommendations are only session long. So session long means that they don't save once I close the browser. So the moment I start searching for something, obviously I usually read like maybe 5 to 20 different things lah. But after that 5 to 20 different things that are kind of related, I close the session. The next time I come on is entirely blank and I don't have any recommendations again. So whatever I search for next will get a new set of recommendations.
Yeah, I think you bring out a good point. I think when it comes to, sometimes it's not about like what we read, right? Sometimes it's about like how skeptical are you when it comes to reading the information. Because for those people who are not skeptical, right, they just read and just accept everything, right? You notice that it's harder to be more thoughtful on certain topics, because in order to be thoughtful, you really need to be really skeptical and question more things, even things like that, like general public or mainstream things that is the right thing. And you need to keep questioning things, think about it deeply in order to come up some insights that other people don't have, right? I think this is very important. It's just that I would say those kind of activities, usually they are very time consuming and very tiring. Imagine those people that every day just questioning things, right? Like you say something that is very, very, people will not think about it. Say, for example, like talk about economy, people will say recession will come. You hear like 5, 10 different people, everyone say that, recession will come end of this year, be early next year. You need to have this kind of counterpoint to say, actually, why you think recession will come? Why next year? Like people have this kind of like more like skeptical mindset and questioning things, right? You will be more thoughtful. It's just that when it comes to interpersonal or comes to communications, usually it will be more tiring, and people, I would say normal people don't communicate and don't operate like this lah. Because imagine that you have your friend and two of you chatting, and everything he says, right, people just keep on questioning, why? Why do you assume this? Why? It's like almost like doesn't trust the person already. So I think this kind of situation is like it's good for the brain in terms of like treat as an exercise, but it's quite tiring, I would say. That's why I think most people, right, is that we will have areas that we don't think about deeply. Like we were just like, okay, I have surface knowledge on like 95% of the things. even things I'll call it like things that I don't know. I don't have insights. But at least each of us, we should have our own areas where we are able to, think deeply, research deeply, know in details, so that we can call bullshits when other people say something that's wrong or mainstream wrong. So I think this is a good mindset to have. But the question is like how to promote this kind of mindset is, I think it will be quite hard because like just now what YCX mentions, right? Like these recommendations, I think recommendation is really killing us lah. For example, like especially those who swipe TikTok, right? After you swipe TikTok for some time, they keep on feeding stuff that you think is correct, and then you will just keep on like agreeing, nodding as you scroll, right? So it's as if everything is right. Then you don't hear the other side of the story. You don't question as much. So they actually turn off the brain function that asks you to be more first principle or more skeptical. It actually kill that part of the brain, which is quite dangerous. But again, I would say need to be more, how to say, you need to have your own way to bring on that part, make it live. If not, it will be, we will just become like part of the algorithm, as in like the algo decide how we should think. So that's quite dangerous now.
Yeah. So I mean kind of like the popular things to look at would be like whatever is related to climate change. So if you see, you go into, you can go into anything and you just search for whatever that's pro climate change, and then you'll start to see all your feed turn into like pro climate change things, and then you read up all on the pro climate change things. Then if you have the opportunity, you like find some other browser or start up a private session, and then you search all the anti-climate change things, right? And then you read, and they also have their own things. It's all there, and then you can kind of see the more you search for something, then the more your feed just becomes that, and then you kind of see you see that there's very big differences in terms of like how things are fed to you and what things are being appealed to, and then you can kind of like train up on something around that way, lor. If I want to share. Because sometimes I also do that because I myself I do buy those oil stocks, all these things, right? And the reason I buy them is because I look at like sector analyses and things, and I see that all the oil stocks are all having like very low PE ratios, and they are all providing like very good dividends. Like mostly in a general trend is that they provide very good dividends and they have very low PE ratios. So then I look at this and I think like, hey, if there is merit in like buying some of these oil stocks, because like they take a shorter period of time to actually, if you think about it from like the dividend perspective, they take a shorter period of time to actually pay for themselves compared to like more compared to like other stocks in other sectors that might actually take like so-called a lifetime to pay for itself, because technically like 20 to 30 PE is considered a lifetime already, if you think about it. So yeah, so when you look at some oil stocks, it's like 10 to not even 10, 8 to 15 PE, right? And then they pay dividends between like 4 to 8%. It's like, even if you're up, let's say you take 30% off of it for withholding tax or something, it's still quite a lot, because you sometimes you might just collect that like 4-5 years of dividends, and then if the price remains the same or slightly up a bit or whatever, you sell it, you still make a comfortable gain out of it, that kind of things. Yeah.
Yep. Thanks for the sharing. I think this one, let's continue with the other one. I think also related. Agree, YCX and BT, good. Thanks a lot. Also like to know more about him and how he do the phishing. Most in the group useless, like just paste link to their video or web gain traffic. Yeah, just now you mentioned a bit like your research method, right? You need to open new session just to stop the recommendation engine to work against you, right? Is there any other like tips that you want to share here?
Kind of like whenever read news, you kind of also take note of who is writing the article and like what is their background when they write the article. Like usually, are they like writing for sell side or buy side? And then what is their track record? Like have they consistently been writing certain, like for example, you see some YouTubers, they consistently hype up certain stocks. Like some, I mean, you can see a lot in tech. You consistently be like a tech hyper or that things. So you can kind of also know that they could be quite knowledgeable in that area, but then they could also have a lot of bias in terms of like they will disregard things. I mean, it is rare for them to like also bring up the counterpoints in what they are hyping. So
Yep.
those that actually do bring up the counterpoints or whatever, those are pretty good. Like I would say. And of course, I also appreciate if like those that actually bring up like historical details or things. Because usually people only look at what's happening now and they don't look back at like history to see. So it's a bit of all these lah. That means try to look at like try to look for any conflict of interest, any the general things like when you go outside and you buy something, you also have to look through. It's not just like the salesperson tell you something and then you just buy it, right? You also have to think through a bit, kind of things.
Yeah.
And the good thing about, I guess, investing is that there's always time. I mean, you don't necessarily have to like buy in all in one shot. Like that's usually not the best way to go about anyway. So it's always okay. Let's say if you buy a certain pitch of someone and you did some research and all the preliminary things seem good, you can always buy a small amount of it first, and then as you buy and then you go through like maybe a few quarters or whatever to listen to how it turns out and things, and then you allocate more over time. It from the, because I mean I'm not like a gambler in terms of like I gamble with large sums and I want to have a performance like in the next quarter or whatever, and that's it, right? I mean, there's a portion of that I try to play, but it's very small amount that is like just for fun and just to test to see whether the things that people say and all these and what I myself think is correct. That's a small portion, but generally the idea is that because I only buy profitable and companies with all the good metrics, right? Then then sometimes these companies, their prices don't move much because they already have like many analysts, all this covering already. So I can put amounts in over time to build up the portfolio. Yeah.
Is there any like top 1 to 3 resources that you definitely will go when you study some companies, let's say from the scratch, like you just notice about this company, is there the top one? For example, for myself, I'll read out like, let's say like Wikipedia is the basic one. So usually it's like very, like concise. You can see what are the, like the historical also just by reading Wikipedia. And now with ChatGPT also, sometimes I just type out on ChatGPT to do some research. At least that will be the starting point. For you, what are the resources that you are referring to? Like for sure you will go to this site first.
I guess Wikipedia, I don't even consider that because like I usually read and then I straight away read Wikipedia first really, but usually to read Wikipedia is to kind of know a bit about the history and to know a bit about like what exactly is their business model. That means like what products or services do they sell or things like that. And after that, I guess the next thing I would do is usually, let's say it's a new company, I will look up their main website. Like what's their main website like? And then because looking at their main website, you can also kind of see like what are the kind of like patterns that they are using to present information, which would then tell you like who are they presenting it to? Is it presenting it to like customers or presenting it to many things, and how diversified their product stack is, that kind of things. Because if you look at startups, usually they present their information in a certain way, and it's just like a scroll down web page, that kind of things, and it's usually only like one product or something like that. Yeah. Then you look at bigger companies, you can kind of see that they have more mature things. I mean, you can just look at Apple, for example. I mean, you see that how it presents, you see some other phone, how it presents, all these kind of things, right? You see from their website. And then, of course, the next thing is on their website itself, you go to the investor relations. And the investor relations can see like just read up on like their recent reports or comments and things. And then also, usually if they are big companies, even small ones, they usually have like a YouTube video or something to explain what their things and things like that. So see the official things first, and like see what they are presenting and things to kind of know and what exactly that they are doing, and how exactly are they like portraying themselves in on their products because that's important. That would set like I think that sets the most important impression before even reading up on every other things, right? The company itself, what information it provides, that's the most important sources first lah. Then after that, of course, is to look at I mean those things like Seeking Alpha, Yahoo Finance, Motley Fool, all these, right? It's kind of like you can kind of see that they are very, if you read enough of them, you can kind of see that they are very momentum based, because they kind of also have some, I think I'm not entirely sure on this, but they kind of also have a kind of recommendation to their writers that I don't know how is it they do it, but maybe it's their writers themselves write on what is the flavor of the month, or they have some sort of way to tell them to write on the flavor of the month. You can kind of see that they usually cover what is the flavor of the month, and then those that are not really that covered that much, you don't see like many articles on them. It kind of like you probably see like maybe 2 or 3 articles on the boring stuff, right? The boring stocks. Like for example, oil is very boring. So you see that it's very boring, then there's just very little things on it.
Yeah.
And then you can kind of see from there that, hey, this thing is some kind of momentum meta going over here. And then you can also look at what is on the Wall Street bets and all these things to also see like what kind of momentum is over there and what they are kind of thinking about and all these things. And over time, if let's say you are in this for long enough, you kind of always notice that there is some kind of pattern to things. Like when things are going up, you start to see those kind of articles like, oh, if you invested 1,000 here, what you get 5 years later based on whatever trends. And like another one that type is like appeal to authority type, like, oh, you see like so and so particular famous person invested in this thing, why, whatever thing, then like how much returns did he make from his fund, whatever. So those kind of things will usually come up for like those pages and things. And then you read already, you also know like there's a lot. I mean, one of the reasons why they write in this way is because it's easy to write, because you take something that's familiar or something that is like authoritative, and then you add a small like spin or whatever to it, and then there you have an article. Like I think even ChatGPT can write this kind of articles eventually. Yeah. So there is that lah. Then you see all these things, then I mean, that's why I say what I read is very like everywhere, because that's how I read things. I look for like the overall patterns, and then I read all these things, and then I think about it, and then I read other things again. Yeah, then that's how I do it.
Yeah, thanks for the sharing. I think we have to appreciate all these articles they are, you know, like writers who are writing it for someone, right? So for those things that doesn't attract attentions, they write already, post already, no one read. Also, doesn't make sense for them to write, right? And also, they're still like, not everyone, like most of them are still depending on like ads. So really, they need the view counts to justify the time invested to write the articles lah. That's why it's always like there's this momentum ongoing. It's just that for some sites like or some platforms, right, the only fool is that they still have a sizable income coming from the members. So they can afford to write things that they think is important rather than those that just follow along with the mainstream. So I think there's some value in it. That's why some people would rather pay, because they know that if you don't pay, you go for those like, you know, like Seeking Alpha or those like just read like, let's say like Wall Street Journal. Then you are actually just follow along the momentum of the markets, which is quite bad because you will keep on just chasing from the tail. Okay, I think that's on that. Let's go to the next one, because I'm also curious on this. Have you sold your Tesla and NVDA? What is your view on these two counter current valuation? Tesla gross margin lower, thus more concern actually. I'll cover the Tesla part. Or maybe if you have comment, you can also comment. But what's your position with NVIDIA? What's the situation now?
I cut down 30%. I mean, I sold at like specifically around the 240 range, around the 380 range, and around like the 420 to 430 range. So these are the ranges that I sold at. However, that being said, because I did do a bit of like options play around the most recent quarter, right? So I actually have a lot of gains from that I further extended by like selling calls on it lah. So right now that position is closed up really. So from this, like, because as you know, when I buy those options, it was around the 240, 250 range and to 300 range at this place. Then that historic 300 jump to 380, my options were all heavily in the money. So I actually gained a lot from that. And then like right now, even though I sold, I trim accordingly to like 70% left, right? But what I'm doing is that over the next 6 months, 5 months left, I guess, I'm actually like slowly dollar cost averaging it back in again. Part of the reason is also because like it is kind of it is for me like portfolio allocation. So I trim it to add to other things. I do also see that the long-term prospects of NVIDIA based on like there are still other vectors of growth like the GeForce Now, the Omniverse, and then also not just like the AI transformers things, that they're also doing like things like all the simulations models, right? So I think there's these like areas of growth that is still there that NVIDIA can definitely capitalize on, because some of their products actually have like synergy together. Like if you buy like their H100 GPUs, it's not just only for AI, right? You can actually pivot to other things as well, and you can use their Omniverse platform and also use all this compute to like do digital simulations, digital worlds, digital twins, and then you can also run. It's not just an AI thing. You can also run like cloud compute processors on it, all these kind of things. So there is a lot of flexibility and cross usage in its products. So, and then it's also still developing better software to extend their leads. And so based on all these reasons, that's why I still dollar cost average back in, which is like my usual standard dollar cost average. But then I just added in like one extra time that portion to it because of all the money that I gained from selling it. So yeah lah. So I will still DCA, and DCA is irregardless of price. It's a thing that I really commit to for that. Otherwise, I will have this large amount of cash sitting there doing nothing also. Then it doesn't make much sense to me. Yeah.
Have you paid a lot of attention to the valuation? Because, like, let's say call it like at the price of 200, maybe you can say valuation isn't like excessive. But now, given that a lot of growth has been priced in, right? Like in the previous bagholder video, I also mentioned that there's like all this growth being priced in order to justify today's value. Have you looked at that, or is that like really not a concern for you? You just let it grow to their valuations?
I think there is because it's kind of like it has like a momentum to it. So the thing is that if I see, I mean, I look at it from in terms of scenario analysis, which is that right now it doesn't even have any so-called competition. Everything that is like everything that is producing, outputting, right, is allocated to a sale already. So they are printing it and it's flying off the shelves like that, that kind of things for at least for its data center products. So this thing is likely to last at least for 1 quarter. Then further on, it really has to see if, let's say, there's no competition that comes up, which is I suspect what will happen. Then a lot of this trend will continue again. So what they produce is literally what they sell. So that means I will look for like the next quarter, like what is the hit to the inventory, because if I see that the inventory is clearing up, right, and then they are also like projecting that because they also committed to like 2nm and things, and then they're also expanding their capacity and things. So generally, if you say I expand capacity, it means you really expect that you have all this demand coming in, that you will forecast that it will taper out at some point. But then the demand is really coming in so hot, that's why you increase production. The risk reward is worth it for your company. That's why you do that. So that's probably what they are doing. And if let's say it maintains this thing and that's all is good, right? Then the current analyst projections that its price range is between 420 to 460 are all definitely going to hit. That to me is kind of like a given. I mean, barring no macro political nonsense. Then on top of that, I don't see the analysts right now talking about the other things, which is like the other things that are more in the background that the analysts don't really talk about, which is the Omniverse things, and then the GeForce Now things, and then also the automotive kind of things, because these things are currently very small to them, right? It's like they don't take up more than the total percentage of NVIDIA's revenue is like 5 to 9% like that. So it's not even like double digits. So to them, it's like, oh, it's very small and we're not going to consider it. We're just going to consider it as like pet projects. But then to me, it feels like, let's say if one of them suddenly has like a sudden influx, right? And then it becomes like a proper, legit revenue growth stream. Then suddenly you see that these analysts will up their valuation models on it again. Then they will probably up it to like 500. Then if they up it to 500, then you see the price definitely will go up to like 460, 470 at the worst case, that kind of things, or maybe just go up to 500 or whatever. If let's say there's some kind of euphoria on it, even, I mean, don't take into account things like PE and things. We're just talking about like in terms of like compared today to yesterday's NVIDIA, right?
Yep.
If you suddenly know that it has these fresh new big revenue streams that are coming in, the analysts will definitely upgrade it to some point on. So that's my view on how certain things of NVIDIA is not factored in by the analysts or by Wall Street yet. Of course, the other counterpoint is that if let's say the interest rates or whatever really does drop it down, and likely will fall down to like the 300 range. I don't think it will fall down to less than 300, but if it does, then it's a good opportunity, I think. But let's say it falls down to the 300 range, right? Then I am still, because I'm still DCing this kind of thing, I'm not really losing out on things like that. So there is this like band that I can play with, that I can see and do further. Sometimes things take time to see what is like the next answer. It's not like the answer today is fixed. You really got to see how it plays out like by the next quarter and then readjust again accordingly. But in the meantime, for me, the risk reward of DCAing now for these particular revenue streams that the analysts are kind of overlooking is worth it for me. That's why I do it.
Okay, make a lot of sense. Thanks for the detail sharing. You want to comment on the Tesla one, or do you want any view?
I haven't been reading up a lot on it recently. Okay. So I mean, it's only periphery, so I don't really have much to share.
Okay, sure. Then I'll comment a bit more on the Tesla. And by the way, for NVIDIA, I think for my positions, right, I didn't start out with a huge allocations. The reason is also because the valuations was quite high, and even at the price of close to $100, right, when all this like revenue drop happened a year ago, I didn't buy a lot. The reason is because the revenue really dropped a lot. So the fundamental was quite like serious hit. That's why I only accumulate a little bit, and it didn't start out with a huge allocations. And even so, I think at its peak price, I think it still become like my largest positions. But it is very close with my other positions. Actually, I can just quickly show like the chart of my current allocations. Here you can see that, like, okay, just come back already. Used to be like, just change positions with Apple, sometimes Amazon and so on. These are quite close in allocations, but it's like not big. The reason I'm holding on to NVIDIA is that it's not like I think they are still severely undervalued even at current price of about 420. It's more like it's not like huge positions. Imagine if my position is a lot larger, right? Quite like 30, 40, 50%. Of course, I could be like considering like what YCX did, which is like just cut my positions by 10, 20, 30%. I could be doing that if my current position is already big, but it's given that it's small positions, and given that there's still a lot of areas where it's not being priced in yet, like the Omniverse that YCX just mentioned, like automotive also, like all the autonomous driving, right? So I'll just keep it there, like not doing a lot on NVIDIA. So similar to Tesla also, I haven't been doing a lot. It's just like the shares that I accumulated in the past, I just let it sit there. So that's on these two companies. There's one more, these questions asked about the gross margin lower. I think Tesla gross margin becoming lower. This has been a few quarters already. This is after they saw that they are not able to sell all their cars, right? So, and they want to get the EV credit. That's why they make some adjustment in terms of their pricing. That one hit into their gross margin, net margin, all get hit respectively. I think current situation is that at least it has stabilized. The question is more like with their current productions, are they able to sell all of their cars? If they are able to sell all of their cars, maybe the price could be stabilized, or even margin could still improve, right, as they continue to scale. And if not, right, if let's say their cars are sitting in the car park, not able to sell, then I'm sure that they will still like be forced to cut their price further, and gross margin, net margin, all this could be going down further. It really depends on how much is the demands. I'm not that worried, given that I'm not saying in Singapore. In Singapore, it really doesn't make sense to buy cars given the COE is so expensive, right? But if you look at the pricing in China and in US, you look after the EV credits, right? It really like a no-brainer to buy a Tesla. So it's quite attractive as value propositions to even replace the ICE vehicle, right? Because now with like lesser parts also, I think less maintenance, cheaper, like you don't have to pump oil, petrol. All this is a benefit if you consider everything and consider the price after the EV credit. I don't think it's that tough for Tesla to like continue to clear their inventory. My sense is it's more likely to stabilize at current level. I don't think they can hike their price back. That's not my base assumption. And I don't think they will have to cut a lot in the futures. So it could be like just stabilized as of now, probably for the next 1 or 2 quarters. Beyond that, really, I have no crystal ball. I don't want to guess. It's quite tough to just look at current quarter. If you want to look beyond like few quarters, that's even harder. I have no insights on that, just to share. So it's just like maintaining the allocations for now. That's about Tesla. Okay. I want to ask YCX on this. Let me jump for these questions first. Let me read out this one because I want to get a view from YCX. A lot of attentions on NVIDIA, TSMC, AMD. Can you share what you think of Intel, Micron, SMIC, especially SMIC leader in China? Can they pull something out of the bag with RMB dollars? So you want to share your view on Intel, Micron, and SMIC? I know that you have invested in Intel previously, right? So how did it turn out?
So my Intel, I actually buy and then I actually like sell after a while because I don't really see any movement to it at any point to it. So I think I probably like buy at 33, sell at 32, something like that. Yeah. So that's what I did. So I'm actually like totally out of Intel as a position. But having said that, I look at it as like I look at it to see what exactly it's doing, because it's kind of like it is still like one of the more like is a very stable trend to look at what exactly Intel is doing, because that's what it has been, the dominant player for a very long time, and it's only recently, probably in the past 5-6 years, that it is kind of like fallen on hard times. But it's still interesting to look at what exactly Intel is doing to show up its weaknesses and things. So the thing that I'm seeing it play out now is that Intel is heavily going back to like its foundries, and basically they want to compete on like the hardware technical side of things. That means fundamentally it looks to me like they are trying to get market share away from TSMC. And then because you know Intel is very big, right? They have a lot of businesses and business models going on within it. So like one part of it is like is doing all these foundries that they also intend to sell to others. And then another part of it is like doing all these like CPUs, either servers or for personal computers. And then that's another part of it. So the personal computers part, all this is kind of like, I take it as it's more of like a short-term strategy that they're doing. But their long-term strategy that they're doing is that they actually really want to go back into all these foundries and be the fab producers kind of things. That's what I'm looking at from what I see, how they are approaching things. And they are, I guess the shareholders and comments, all these are kind of like all approving of this, possibly because the shareholder mix for their stock is not similar to other shareholder mix as well, because you've got to remember that Intel has been around for a very long time. It's, I think, around for 50 years or something already, right, at this point. So their shareholder mix is also very different from other companies. So they are okay with like it. To me, it seems to me that they are okay with like playing the decade-long game and not like the 2 to 3 year plan game like that. That's what they're doing, and they don't seem to have any cons. They do bring it up from time to time, but in terms of like you see the kind of debt and the R&D that they are spending and all these kind of things, it is quite big, and the returns is not really that high compared to like NVIDIA or AMD or something like that. But then they are still okay with spending it. And I think part of it is also probably geopolitical, which is why you kind of see that they are going around and getting subsidies from all these governments to build up for these fabs in all these different areas to kind of like make it. That's what they are doing. Also, it's not just like we look at it from a purely fundamental space, but you also have to look at it from like the US government, the other Western governments are very supportive of what it's doing because they are kind of like also aware that this semiconductor thing is like a choke point that they cannot have risk having this choke point be a geopolitical issue if it really comes down to it.
Yeah, so the foundry model, this is the IDM 2.0, right? I don't know whether you keep track on their progress over time, but at least based on my observation, I don't think they are executing that well, given that we don't see quite a number of other customers that jump into this IDM 2.0. Because for example, right, let's call it like NVIDIA or AMD, right? These companies, they can actually not just using TSMC or Samsung, they can actually jump to Intel if they're able to produce. But the reason they haven't really give some contract to Intel is also because maybe they are not ready, right? Why exactly what they are not ready, I can't tell. I don't know all the details. It's just I don't see any new customer because at least that's something that I track. Is that a concern, or is that you share the similar observation as well on that?
Yeah, that's why I take it as like it's good to observe and wait and see what exactly is happening. That's why I'm not in a rush to like buy it or anything. Like at the first point where I buy it, I was expecting like maybe it might have a turnaround soon. But then I kind of see that its plays were kind of a bit more drawn out and the roadmaps are not really making sense to do things now because as it stands, TSMC is still the leader and Intel is targeting like maybe competing in 2025 onwards. And that is just like targeting. It's not even like reality yet. So there's a lot of factors. And of course, because it's not reality yet, you also cannot see many orders for its things. Or people will be like interested to try it out. Of course, definitely for this kind of things, they will try out like to see whether, because they also want to have alternative sources. And but ultimately it's kind of like it's like, I mean, you probably can compare it to like commodities or oil or something, whereby they produce and you kind of see whether since they are not producing yet, right? Of course, if you produce, I'm interested, but then you're not producing yet, I also cannot commit to it or anything because the chips that I need are like 3 to 6 months later, and your timeline is like 1 to 2 years later. How can I commit to this at this point in time? Which is also why I see like, but having said that, that's why I think it's kind of like they have pitched to all these governments that they are definitely building these factories, definitely. And they have pitched to these governments that they are producing, and the governments are buying into their roadmaps and providing the subsidies to build these things. So probably something will come out of it at some point in time. It's just a matter of like when, and when they do come out, is it like the cutting edge or is it like top of the line but not cutting edge? If it's top of the line, not cutting edge, it's still usable. It's just that I won't expect that it will be like a meteoric rise or anything. And you also got to kind of consider that they have profit sharing agreements with each of these subsidy providing governments. So there's a lot of like contracts there to read through, which I don't find it like right now worth the effort for me, given that they are at this point in time. Maybe in some future I see and I think through and I might look through exactly to see how is their revenue stream makeup, and then for all these fabs, right, how much they are spending on each fab and what exactly are the kind of agreements that they have with the governments in terms of like what are the subsidies that they get and what they are supposed to fulfill contractually.
Yeah, I think you made a good point just now about their shareholders, right? I know that this IDM 2.0 require a lot of change internally, and of course, when they want to get to 2 nanometers, right? All these are very costly, and still they get some support internally to do it. But I'm not sure whether the current shareholders they are happy to see, given that actually quite a huge proportion of all these shareholders, they are demanding dividends, right? So as you stand from the perspective of the management, you have limited of capital. You need to spend capital on R&D to build fabs, to pay dividends, to pay the bond interest coupon, all these things. There are so many commitments. I don't know how they are going to prioritize, because if it is a lot easier if the company is not making money and yet they are able to get in shareholders. We know that these shareholders, they are really invest to want to see the end of it, right? But given the Intel, you imagine that you are the shareholders that really rely on the dividends for your retirement. Now suddenly you say, oh, I need to bet on the success of their 2 nanometers, right? So it's very, like, I would say, the current shareholders might actually bail out before or leave the companies before the new one that want to come in. The new one want to see some results first, but the current one, the dividend shareholders might actually exit beforehand. So I do think that their situation is quite tricky. Of course, they can get some support from the governments now, but still yet to see, like, are they able to get a lot, or maybe it's not that transparent over there. And there's another layer, which is all the results, right? Like, can we really see they are executing, they are able to get to the roadmap or not? There's still a lot of question mark there. That's why I'm very, very skeptical on Intel, whether they are able to do that. But Intel aside, do you have any opinion, any take on Micron and SMIC? These are actually quite interesting also, right? Like they are very different from Intel. Micron is more on the memory business. SMIC is similar to TSMC, but they are like China, so they are different. So you have any view on these two?
Micron is very even closer to commodities than Intel. It's not to say that they don't innovation or like proprietary tech or things. They are very good at their memory stuff. It's just that memory in this computing stack is kind of dumb, for lack of a better word, because I have looked through like how memory works, and it's actually quite dumb in terms of like how it transmits signals and receives the signals, that kind of thing. So there is not much that can really be innovated in this area that I see for the time being. Maybe they come up with something special, but I don't think so. Because memory is more of like a commodity, and they're really just innovating on producing better memory. That's about it. So it's a business that definitely will have sales and definitely won't die, but it's also definitely not going to, like, say, you will not see, like, say, suddenly 2, 3, 4x or something all of a sudden one. Because they are like operating at like the physical limits of their technology kind of things, and any breakthroughs is because they manage to like have some kind of physical breakthroughs, physics breakthroughs. Like, for example, if you produce like DDR, like you have DDR 1, 2, 3, 4, 5 now already, right? The DDR is basically just the double data rate, and whereby you try to squeeze as many zeros and ones into your feed, and then you read it. So every time that they manage to is they squeeze twice the amount into the same space, right? So they just keep trying to squeeze more and more amounts in the same space. The same goes for like SSDs, those sort of cells and those sort of things. You have like SLC, then After that, you have like they call it what, MPC, but it's actually double MPC, then TLC, then QLC, and then the next one, I don't know what they're going to call it, but essentially they're going to squeeze 5 numbers in the space of one, whereby previously they squeezed 4 numbers, 3 numbers in the space of one cell. So that's how they are doing it, and they are just squeezing it. And then, of course, you can squeeze it in, but then you also have to take into account that when you squeeze it in, it gets slow or whatever, and they need like to design a new controller to be able to handle the slowness or whatever things that's over there. But it's essentially the same thing that over and over again. It's just that you are trying to balance and optimize it so that you eliminate the trade-offs while gaining the capacity or the speed. That's about it. From how I look at Micron's products. Yeah.
Yeah, it's more on like cost advantage. If you are able to, achieve the scale. And in fact, like Micron, I think they bought up quite a number of other fabs in Asia region, in China, in Southeast Asia and so on, and maybe in Japan also. I forgot where's the place. So with the large scale, they're able to have some cost advantage, and that's how they squeeze the margin out. I think that's their main business. It's not so much on there's a lot of moat within the business. Like you said, it's more like a commodities. It's really a commodity. It's not just like a commodity. That's Micron. SMIC, and any thought on this?
It's hard to actually. The issue I have with SMIC is that I find it difficult to look up information on it. So the way the information is to me is like, compared to like the more Western companies, right? The data sources on SMIC on the internet, at least, because I can't possibly go down to their China factories. I don't have that. I mean, it's not. I don't have that capacity to actually go down there, and it's not worth it for me in that sense. So since I cannot, and even if I can go down there, I also don't know who to ask and how to actually go down to see. So it's hard to find information on SMIC for me. So I don't really. I mean, what I read about it, I'm aware is very one-sided or biased, and very subject to like the quality of the analyst that is writing the article on it. I can't really verify for myself, so I find it very difficult to give a proper analysis or comment on SMIC.
Yeah, same feel. I also think the same. Harder to. Like sometimes they come up with some news that, okay, they have some breakthrough, all those. I'm very skeptical. To me, if really they are very successful, of course we will see like on their revenue and so on. But for now, I don't think they are that near, like close to Samsung or TSMC level. So this one, there's potential. Depends on how good are they at executing. It's just that now with I think US like do a lot of like technology blockade. So I don't think it's that easy for them. But the interesting that I found out from the book Chip War is that SMIC, when they started out, actually is very similar to how TSMC was started out. It's essentially a copy of TSMC approach when it comes to how they run the business, foundry model and so on. So it's very, very similar. It's just that they don't have the same kind of results. This one also is kind of like it's a mystery to me because I didn't read as much on SMIC before. So I'll give it a pass here. Yeah, so I think that's on these questions. Thanks a lot, YCX, for all your sharing. Let's go to the other questions because I think we have still long list of questions. I try to cover as much as possible within the next 30 minutes. Okay, let's get with this one that we just skipped. AK in his Amazon video called Calculate Intrinsic Value, he used operating cash flow US 33 billions and discount backward instead of free cash flow. Is it mistake? Capex in data center and warehouse is huge for Amazon. I need to say that I haven't really watched his full details on Amazon that include the DCF, or maybe I watched the video but not to see in detail how he calculate the DCF, do the intrinsic value calculations. It's just that if I just read from here, right, if you just say operating cash flow versus free cash flow, of course, the difference is the Capex, the full total Capex. And yes, for companies like Amazon, right, the data center business, their Capex, right, is quite huge one. So indeed, if you just read this on the face, right, is that if you omit the Capex and just do operating cash flow and do a calculations, I would say it is like really overstating the valuation of the company. But I do see the points of like really you have to rely on something else and not the free cash flow. Is because if you look at their free cash flow, right, it looks something like this. This is Amazon free cash flow, and this is last 12 months. In the past, right, they are, from even during the period when they are not profitable, but at least their free cash flow is like in the green. So they are able to generate cash flow. And then you see the pickup in free cash flow in the years towards like 2020. And then after that, during COVID, like after COVID periods, right? Like within 2022, you can see that their free cash flow actually dropped to negative. This is because they spend a lot of money into their logistic, build out their network. But in the end, they don't see the demand. So they actually burn a lot of money here. When you spend a lot of Capex and the Capex is underutilized, right? Basically, you have to absorb the cost. And that costs them have like a negative, like as much as close to 30 billions a year in free cash flow per year. So this is actually quite costly. And if you do a valuations and your starting base free cash flow is negative, it's very hard for you to like come up with some assumptions, right? Basically, you won't need to see, okay, this free cash flow, I don't know, maybe like negative certain percentage, right? You might want to do, if my approach is that I would just assume the margin to continue to improve in the years ahead. If you don't want to do that, right, you can just like using like other approach is that you need to find something that's positive and discount the positive things, which is that in this case, I believe AK, he probably take a shortcut and just take the operating cash flow and assume this one as a cash flow and do a discounting back. It's just that please be aware that if you do these kind of things, yes, maybe okay, but you shouldn't pay as much multiple on the operating free cash flow because you haven't deducted the Capex. Because imagine, right, let's say a companies, they are able to produce operating cash flow, but Capex equal to operating cash flow every year. Meaning that every dollar that they're able to generate from operating cash flow, you just spend it back on the Capex. And if this pattern continue for many, many years, right, what it means is that this company don't have any free cash flow at all. You are not able to come to extract cash flow from the business because you need to reinvest back to the business for the business to be viable, right? So it doesn't make sense to pay any multiple given that there's no free cash flow, right? So please be aware of that. So like I said, you can come up with your own like creativity to see which variable you want to use to do DCF. It could be like operating cash flow, could be net income, could be operating income, could be like you can use whatever metrics. It's just that you need to aware the problem of that method. Like what's the, like, it doesn't solve the problems. Basically, you just need to know that okay, if I do use operating cash flow, then come up with high valuations. The question is always that can that money, a portion could be a huge portion you might not able to take out due to Capex. So that's my take on this stuff. But I can't comment that much until I see his intrinsic value calculation in details. But doesn't really, I would say doesn't matter because this is his approach. As long as it help with his like assessment, that's good enough, right? If you ask me, I will look at the model. I will do some changes to suit my view on the company, and it's useful for me. And someone else might jump in to say, okay, there's this area that you do it may not be appropriate, which I think also possible, right? Because all models are wrong. All models is just for us to simplify the actual situation, which is too complicated to analyze. We need to simplify it into something that we are able to digest, and then we use it as a tool to help us with the decisions, right? It's not like which model is better than some other models. You just need to be aware of the pro and con of each model. But in this case, given that the Capex is big, it may not be appropriate. That's my answer to your questions on this. Okay, let's move a bit faster. Hi Boon Tee, if you don't have Kindle now and looking to buy one, which version will you buy in your shoe? Thanks. Okay, let me pull out something here. Okay, actually, this is my Kindle. I bought this one from Amazon. And this is, I think, the latest one, Kindle Paperwhite. The reason I went for the Paperwhite is also because the screen is larger. It is 6.8 inch, slightly larger than the basic one. And I got, I would consider a good deal from Amazon.sg. This is the Singapore website. I got it at $167. I think really worth the money, I think. But I just checked at the website, same website, and checked. I saw that the basic one is $113. Actually, you can get this with Prime. I think the Prime also you can get like a try Prime and then just use it to buy the device, right? $113. I think you will not regret it. And especially for the new buyer, right? If you never used Kindle before, you also don't know whether it's suitable to you or not. So I don't think you need to buy the Paperwhite editions to get the larger inch, right? Larger screen, right? You can just buy this one. In terms of the functionality, I think it's the same one. It's right. Really, you want the e-ink screen, right? That looks like paper. This one will give you that functionality. And also, I'll say, this is better than the Paperwhite because of the size. Because 6-inch screen, right? Actually, on your hand, right, is more comfortable than the 6.8 inch. So especially for me, my hand just like a topper, like the normal size, right? I still can hold the 6.8 inch, but I would still say the smaller one is actually more comfortable. I checked the price for the Paperwhite. Actually, it's not available on Amazon.sg. There's no stock. But actually, if you buy on other sites, right, like Shopee, I think it's available there. But it's quite pricey. That's why I would recommend this the basic version, which is only the $113. So you can try to get this device. This is my recommendations. Okay, that's on the Kindle questions. Let's move on. Windows 10 run until 2025. Does it mean those laptops whose specs can't upgrade to Windows 11, they will become useless as can't update? So I think until 2025, if you use Windows 10, I think you just cannot do the upgrade. That means you cannot upgrade to the latest security update and so on. So definitely can continue to use. It's just that you'll be more vulnerable to some security threat and so on. I don't think it is an issue. And maybe, for example, let's say like new hardware, let's say a new software or hardware that the driver cannot work on Windows 10, there could be potentially some issues there. But that's usually is like few years after 2025. So I would say by the time it's already quite old already, your device. So I think it's not a problem. Yeah, I'll just say if the question is whether to us become useless, the answer is no. You can still use it, but what kind of problem that you will be facing is that you can't upgrade the security upgrade, and also some driver, some software that you may not able to use if you are still using Windows 10. Those are the problem. It will not be that visible maybe from 2025 to 2027. But after 2027, right, which is like quite like 4 or 5 years from now, right, you'll be issues later, especially if you are buying new hardware. It might not be compatible and so on, right? So that's why if you are buying a new PC, maybe I would say go for Windows 11 because it's more future proof. Yeah, that's my answer. Okay, next
actually,
one. Yes.
Actually, 10 and 11 is the same underneath. So actually I think it's Microsoft lying. Yeah, 11 is actually 10. You really, I'm serious. 11 is actually just a reskin of 10 with lesser features. So no need to worry about it. I think, and given like how 10 is, how 10 was marketed and how 10 was originally developed with, what the intention of 10 was developed with, right? I think even though they say they will remove support or whatever in 2025, they won't do it. They will probably extend maybe a year or two, and then after that, they will still provide support all the way until 2030 or something. It is essentially like the Windows 7 of this generation. So not much to worry. I mean, even if you want to upgrade, I wouldn't say go 11. I would say, and I mean, if it really comes to 11, then whatever lah.
Yeah.
But if you want to upgrade, you should look for like 12 or something, because 11 and 10 is the same underneath.
Yeah. I actually won't recommend upgrade. Let's say if you are currently using 10, the laptop or whatever asks you to upgrade, I won't recommend that, because I noticed quite a number of experience from friends, right? After upgrade, the device got issues. So usually they perform worse after the upgrade. So that's why I said, if you are using 10, can continue to use 10. If you're buying 10, also not a big problem. But if they ask you to upgrade your 10 to 11, probably don't do that. There's some risk to it. But let's say if you're buying a new laptop or PC, might as well go for 11, right? Because like you said, 11 and 10 is the same. So just go for 11. I don't think it's like much more expensive or what, right? Will you agree on that? If you're buying a new one, will you go for 10 or 11?
To me, I would go for, if it really comes with it, then take whatever it is. If you're more savvy and you want to flash your own, then I will still flash 10 at this point in time, because the underlying is actually 10. Is 11 is just they built on top of 10. It's not like it's an entirely new OS to it is really a reskin of it, that's all. And anyway, in terms of like support guides or everything, let's say you have like some issues, there's actually a lot more documentation on 10 than on 11 for now.
Yeah, that's true. See what's your priority for future proof. Maybe get the new one, but for like you say, like more resources, like more things that you can play for the savvy one, that you might want to go for 10s. So I agree on that. Okay, continue for a few more. Intel building so many fabs in different continents, countries, spending billions. Is it either boom or bust scenario? Any chance of good ROC for them? You want to comment on this?
YCX? Like what we said just now, I think it's too difficult to tell. Because there's so many moving parts.
Okay, I think this one, right, I actually pull out, where is it? Okay, this is the list of their current fab sites. And if you look into the bottom parts, right, you will see that, okay, there's all these like Arizona fabs, right? 2024 here, 2024, 2025. And then they have, I think Germany, okay, Germany here, you have 2027, maybe Italy, 2027, and Malaysia as well, like packaging. There are a few things that's running, but actually I don't think like these are, like a boom and bust scenario. There are two reasons why I say that. I think actually as of now, if you look at the fab wafer demand and supply, right, it's not like crazy, even with all the AI things that's coming, right? Actually, if you look at the trend, right, actually you can see here, they are going up as per like normal. Of course, if you look at the forecast, 2022 forecast, yes, the slope actually steepened a little bit, but it's not crazy, right? You can almost plot a flat line here, not a flat, like a straight line here, just to say that actually they have been growing like at a relatively stable rate over years. That's one reason, is that in terms of supply and demand, they don't go like crazy within like recently, like it's quite stable. Second reason is that we don't have to worry about them, because for all these chip companies, right, actually they know that if they spend a lot to build up their capacity and there's no demand, it is super costly. It's much more costly compared to, let's say, like 5 or 10 years ago. Nowadays, all these fabs, right, with the equipment is super expensive. They really do a lot of research to make sure that the demand is there before they build the factory. So that's why I'll give some confidence to the insights, to all these, like the insights gathered by all these chip companies. They won't spend crazily one, especially now. It's not like they have like 20 different companies that operate at about the same scale. So everyone, they want to outspend the others to make sure that they have all the capacity and they want to grab market share. It's not like that, right? Because nowadays, especially on like, like those 3 nanometer, 5 nanometer, 7 nanometer, all this, right, it's just like a handful of companies. It's either TSMC, Samsung, Intel, maybe you can squeeze in another 1 or 2, right? And that's it, right? Given that it's oligopoly situations, they all know the situations. They will only build when the demand is there. So that's why I would say I'm not that worried. Even if Intel, they announce like new factory, I think these are just normal, like business as usual, that they just expand over time. Because if you look at all this demand, right, also going up, of course, they have to build more fabs. And they have to build more fabs for the advanced, like leading edge process nodes, right? So they have to do that. It's just that you might see there's a lot of news coming out, but that is not representative of the actual output, right? So I would say actual output probably just going along like this kind of level in the future. I don't think it's like boom and bust scenario. That's my feel. Yeah, good chance of ROC. This one, I think in terms of supply and demand, I don't expect a lot of surprise there. But the place that will surprise us, right, is that what kind of pricing that they will command. Because for NVIDIA situations, right, they know that they are cheap, right? AMD might come up with their own AI chip, but because of how established they are in their platforms, right, they know that even they charge higher, customer will still come to them. That's why they have more pricing power as compared to the others. But come back to Intel, the question is how much pricing power do they have, right? So that is a question mark to me, because in terms of their CPU chip, right, whether the consumer one or is it like the server one, they still need to compete with AMD. And then in terms of their graphic chips, they still need to compete with NVIDIA. So with all this competition around, in terms of the pricing power, they might not have as good pricing power. This is very different compared to the others. For example, like Apple's, right? You know that they have their fan base, right? Apple, they always charge a certain level of pricing, and their customer will always come back to them. So that's to me is a pricing power. But when it comes to x86 architecture, CPU, all this, right? There's always competitions versus AMD, versus like NVIDIA and so on, and also versus Apple, right? So I do see that in terms of pricing power, they might not have as much. So that one might affect the ROC a little bit there. That's why if you look at their recent earnings, it's not that good because they have been dumping their chips to compete, right? So that will be a concern. But in terms of overall industry supply demand, I'm not that concerned on that now. Yep, that's on this question. Okay, next one. You keep saying watch a Jensen Huang video will know about NVIDIA. Can you advise which video? Very easy. Just search NVIDIA GTC keynote, and then you will see, because this keynote is not annual one. I think it's every year they have 2 keynote, and then you can just search 2023. Just scroll around. You can see 2023, maybe some 2022, and focus on those that is longer one. Don't watch 3 minutes one. The long one, right, is at least 1 hour. You see this one 1 hour, this one 1 hour 55 minutes, and I'll suggest you watch at least 3 years of all this, right? Then you add up together maybe 6 GTC. Each one of them could be 2 hours. That's 12 hours of video, right? You can watch it at 1.5x speed if you like. Then just try to understand what are they doing there, right? Because I'll say it's still quite technical in some area. Like you can say they keep on hyping up their autonomous driving and so on. But from there, this is the starting point. From here onwards, you can still continue to do your own research, right? At least here, you will know the future that they're heading to. They will talk about their gaming, what kind of the DL, DSS 3.0 or whatever. You can know that, okay, there's some advancement or some innovations in the software part to help them come up with some products that is better compared to the previous generation, right? You know, these are the product that they are focusing on. At least you know their product. Then from the product, you know okay, whether this is a future that you want to bet on, right? So I think this is just one of them. Of course, you can watch the other interviews. I think those are quite helpful as well. So these the questions. I think this is something that I mentioned before lah. But there's a lot of video that you can watch. Just do the keyword search that I provided just now. YCX, you have any other video that you would suggest people to watch to understand NVIDIA? Especially for those who are new, like those that don't know the company at all.
You can watch their product announcements or kind of like
which is GTC, right?
GTC, yeah. Usually they do it on GTC, and also I mean, you can go to news.nvidia.com or something, and they have a lot of news. They have it almost every week that they are showcasing something. So there's many things on it to read in terms of they really are like a kind of like a science company. They do a lot of research, but then they also like capitalize on their research to do a lot of actually, if you get how much research that they do on in terms of like all the graphics things, right? A lot of it is actually not used. It's actually like they sponsor a lot of PhD research into this area, and they do a lot of in-house ones as well. And they have a very high focus on all this research and pushing out like new things that they can finally monetize on. So yeah, I think the recent Computex one is pretty good. But because like all the videos are all like very long, 1 to 2 hour plus, right? If you think that it's very boring or whatever, I would recommend that you probably watch it or listen. Listen will be quite hard because you need to see its visuals to understand what exactly they're talking about. So maybe if you have like a treadmill or something, you run on the treadmill or doing some workout and you watch it at the same time. That's what I do. So that's what I would suggest. If you are working out, you can watch it at the same time.
Same recommendation. I think GTC one is really well packaged. Nice graphic, nice animation. I think definitely will advise you to watch that. If you watch it already, you still don't like, then you can stay away from the video already. Okay, next one. Seems like Xiaomi, Oppo, Huawei have their own OS app store. Android too dependent on Samsung. Is this Android mode eroded as Samsung or others can do their own? YCX, you want to answer this one?
I think because it was open source in such a way, right? It was never a mode to begin with. The whole intention was that the Android model was to take market share away from Apple. So in that way, they did it already. So like this, they all have their own OS app stores is by design. Is literally, they are all competing on brand and trust lah. So they all use Android, yes, but then because they can take their Androids in different ways, but Android is primarily like built by Google, kind of. So most people still like go back to the Google, and then it becomes like they also compete on like the OEM side, which is why you see which OEM comes packaged with what Android and what their own version of things like that. So it's all like by design, and you compete on brand and features really. That's it lah. Originally it's just to take away Apple's market share.
Yeah. But it still give them some strength, especially they own the OS, right? I will just give one example. Remember the situations with Facebook or Meta caused by the iOS privacy changes, right? Actually, Facebook, they hit badly because of this change, because whether their apps run on Apple, it also suffered from the iOS privacy. And then ran on this Android also, there's some privacy changes that affect them, right? Basically, they can't collect as much data, but in Google's situations, at least all these Google Android phones, right, whether it's Samsung or other brands, right, doesn't really matter, but at least they can still get the data themselves, right? So compare these two, I would say Google, because of the Android, they actually not as heavily affected. So that actually help them cushion a little bit. They are not depending on Apple's. You agree on that?
Yeah. I think they, in general, you see that the trend is that they all copy each other. It's just sooner or later only.
Okay. Yep. So yeah, I think depending on the questions who ask this question, I really don't know like what do you mean by moat now, because like Google Androids, right? It's never like how to say it's not like the business model really is not depending on them having their own app store and then charge money on app store. I think that's not Google's business model. It's not the same as Apple. Apple one really they really treat their app store as their garden, and then they really charge money on that. So it's very different here. And for Android, that's why I said in the beginning, right? I said the most important thing about any company is really their business model. In Google situations, right, their business model is always about advertising. So all the stuff that they are doing, right, is like revolve around advertising. Similarly, like for example, Facebook, right, their business model is all around like social network and monetize social network using advertising. That's their core DNA, right? That's why when it comes to their VR approach, right? Also, they don't care about like I need to make the best VR. I just want people to use my devices to connect with people, because the connection part, right, is within their DNA. Whereas for Apple, their DNA is more on like creating like great devices. That's why when they create their Apple Vision Pro, right, they really create like as the best version that they are able to create. So you can see that if you understand their DNA, you can understand their business model. You see that the DNA, right, is very hard to change one. Whereas for tactic or strategy, all this can change over time. But the DNA, it will stay for some time. So I think we covered this question. Next one. Seems like TSMC, Intel, Samsung, global foundries building new fabs aggressively, causing spike in supply. Will demand be there? Have there been such huge supply before this? Just now, I think I shared the slides already. I don't think that it will be that different if you plot the chart extending, moving forwards. I don't think that's an issue. And if you just look around, right, even let's say for cars, right, definitely they are using more and more chips. Even like what they call the IoT. I know this is like some names, but IoT is still a thing, because for example, yesterday I just saw an advertisement on a refrigerator. It says that for example, your fridge door, right, didn't close properly. Actually, they can detect and just send notifications to your phone. I think all this, right, you cannot do it with the current like if your fridge don't have the necessary chips, right, it's not able to just send the signal out. Just to send the signal, you need some chips to operate, right? So all this, definitely there's more demands for chips in the future. That's why they are building all these fabs. So I'm not that worried about the demands. So that's my take on this. If more fabs, does it mean fabless players like AMD, NVDA benefits because more supply forcing manufacturing prices down, and fab players TSMC suffer? Yes, I do agree on this. Let's say if really, this is all about supply and demand, right? For fabless players, they basically just design the chips and they need to procure like all this they need to procure manufacturing from the foundry, right? From the foundry. So if there's more player, there's more competitions, it helps them with the pricing, right? Whereas for TSMC, as there's more and more other foundry players that compete with them, it's harder for them to actually have pricing power. But you need to understand, for TSMC, they don't really compete on pricing. That's something special about TSMC. They can negotiate on other things, but not the pricing. They really charge on the premium price, but in return, they give you the best product that other competitors might not able to provide, and they are very reliable when it comes to like delivering. So that's the value propositions. It's not about the pricing. So that's something different. But anyway, like when it comes to like there are different foundries producing similar capability, right? Of course, more competitions means that they are not able to charge as much as they would like. So I think this is like economy 101. You won't deviate much from there. There will be a pricing regulations just from the supply and demand itself. So yep, that's on this question. Chip Wars book, very good. Allow me to learn so much of semicon industry. Is there any similar book covering this or other sectors that you recommend? I think there are quite a number of books. In fact, previously I wrote a blog, a Substack on the list of books that I read in the past, right? Maybe I just bring out a few. So just now we talked about this chip war. I think this book is very good because they talk about the history on when the entire chip or semicon industry started. It actually started out from like just the defense industry, and then from there they roll out to consumer industry into all these like radio, don't know, or like I mean it started out to from defense to consumer. So very interesting book. I would highly recommend this book. But for other books, right, I just name a few here. Like this book, right, After Steve, How Apple Become $1 trillion company and Lost Its Soul. I think it's very interesting because it discusses about the situation or what's happening within the companies after Steve Jobs passed away. So basically he discussed about like era after Tim Cook become CEO. I think this is quite interesting one. And then, of course, for those who invest in Amazon, I think this is a must read, The Everything Store. This is also quite a interesting book that talk about the beginning, the set out of Amazon from bookstore become everything store. I think didn't discuss as much on AWS, but I don't recall. I read this book for a few years back now. This one, Hit Refresh, book by Satya Nadella. This is more about his personal history, personal story. Maybe not so much on Microsoft, but it touched on a bit on Microsoft as well. And then I think this is also quite interesting. How Google works. You want to understand Google, you have to read this book. Actually, it's written by Eric Schmidt, right? He was the CEO of Google for some years. So you can read this one. And then for those who want to like achieve higher ROC, you might want to read this book, The Four, from this professor Scott Galloway. Just one book, it covers like 4 companies already: Facebook, Google, Amazon, and Apple. So also quite interesting one. And of course, for those who like if you are Elon Musk fans, if you haven't read this book, I don't consider you as Elon's fans. You really have to read this one. Really tell a lot of story on his previous like all his previous ventures before he set up Tesla. So I think this is quite interesting as well. I would say books is still the way to go, right? If you read book, you can go to the in-depth, right? So I think that's interesting part about reading book. Whereas if you just watch YouTube videos, right, it's just like covering surface. It's harder to go into the details if you just watch videos. Okay, most group chat stuff, Twitter, YouTube, blogs are useless. I don't know. Why so extreme when commenting on Twitter, YouTube? I would say it's not really useless. It's more like there's a lot of noise around. And really depending on the recommendation engine. How good is your feed, right, is really depending on the recommendation engine. And it also depends on how you consume the media as well. So if everything get fed to you is useless, maybe there's something wrong with how you consume the media as well. So need to be careful on that. Then questions for YCX. How YCX filter the good one? Because a lot of he waste of time. Is it he follow particular person, writer, or guru? I think you cover a lot in previous sessions. Is there anything you want to add here or not? If not, we can skip now, because I think you shared a lot already.
I think the opinion matters more than the whoever is writing it. So yeah. Always look at the opinion. Look at
the
each
person.
Not look at the person, look at the opinion first, and then value the opinion based on logic or first principles first, before looking at like the underlying things that like the person's credentials or whatever. Because if you go into any any opinion with already underlying bias, right? Then chances are you'll not have you won't form the right you won't understand what exactly that they are saying, or like how they are saying it on things. So just look at every opinion as logically does it make sense to you and things like that, and then like what exactly are they looking at. Then after that, then you consider whether is it that they are biased or whatever. That's how I look at things.
Yeah. I think the deciding whether where's the bias, I think that's the most important one. And we need to know the person as well, right? As in we need to know the writer in order to know the biases lah. So it's very hard to skip lah. It's like you read without knowing who is the person that wrote the piece, right? It's harder to interpret lah. So the bias drive a lot on and the intention basically it's the same thing lah.
Okay. And then also people change so people change so it's not always that they hold the same opinion over time. So yeah, that's why look at the content of the opinion or whatever first, or the article first before considering other things. Yeah, because like if you say, oh, whatever website, whatever news is on Fox News is automatically biased or whatever, then you're already biased towards it, and then you won't consider what it says at all. But if you look at things like through like things change, and like what is good today can be bad tomorrow, that kind of things, right? Then you have a more balanced viewpoint.
Agree. Okay, these two questions I will combine. If YCX have 100% cash now, which counter or market would he be monitoring or buying? Is YCX still holding to oil counters? Is he still bullish on oil? So I'll pass it to you to answer these two questions.
I have 15% of my portfolio in oil related things, which is to say, in the oil stocks. Generally, I buy oil stocks that are profitable and dividend paying. That's one. The other thing is I do like speculate a bit on like the futures of oil and natural gas as well. So that's another. And then if we were to consider more tangentially, is like for commodities. I do actually also own like commodity producing stocks, which is generally I prefer the ones in Australia. Right now, the Australia ones and the US ones, because I think that they have more potential for growth, and also they are more shielded from those geopolitical concerns that usually plague more Asian or European companies. And so that is what I'm looking at in terms of oil. Yeah. As for oil, like, why am I holding on to it? One thing is, as I mentioned before, they pay good dividends and their PE is low, which means that they actually like is very. If I hold on to them for like 5+ years and I collect enough dividends and then later I sell off the company or whatever, I pretty much already make quite a sizable profit from it. Like from there already, that's one thing that I look at. Then the other thing I look at is that I do notice that there is like a cycle with energy, which is that energy is always downplayed. Like oil is always downplayed. Like people will keep like shunning it and downplay it. Then the moment there is some kind of like crisis or some kind of recession, you actually see that energy doesn't actually get affected as much. So it's a very like it maybe it drops over time, but it's pretty stable. And once there is some instability in the market or the economy going on, you can kind of see that energy is doing pretty okay. They are not really like that. They are not really like that negatively correlated. They are usually like slightly negatively correlated or uncorrelated or positively correlated with bad news or whatever. If you look at it that way, they are more likely to have that kind of effect. So it is a hedge, and it's also, I see that it's a good paying hedge. That's why I think it is good to diversify into this area, and I hold 15% of it in there. I intend to hold this 15%, this number, maybe go up to 20% if I do think that like things are really getting too cheap. But then to me right now is 15% is what I'm holding on to and targeting for the time being. For my portfolio allocation. Then commodities wise, I'm also looking towards like, or the other thing I also look at is also the trend of like demographic change. I do notice that demographic change wise is that there's a lot of movement out of China, and there's a lot of movement out of India and like UK, this kind of countries. So, and where they are moving towards is actually towards Australia, towards UAE, towards Singapore, towards Canada, this kind of area. So I do think that if they are moving towards these areas, right, because basically these people they are moving, usually they are the rich ones. So I typically look at like the rich ones, right, that they are moving to these areas and they are working in these areas and they are settling down in these areas. You can kind of also see that the trend is that their currency is very stable in these countries whereby the money, the people are moving into them. So that's why I also think that when I buy those stocks that are dividend paying or like commodities or energy wise, right, there's more physical. It's good to be in these markets whereby the currency itself is stable, so it's predictable. It's not like suddenly the currency drops to like some Argentinian number, that kind of things. Then even though it's producing well, you're not going to get much from it.
Okay. All right. Thanks for sharing. Just now you mentioned Australia. Those are minerals, right? Mineral commodity or something else. It's like
I mean, I'm still researching further on it. I'm slowly adding into. I mean, I've been adding into BHP since the start of the year. So I'm still adding into BHP and reading up more on like how the Australian economy is and what it is. I mean, BHP is pretty large and it's like of their mainstay. So it's very stable and it's very predictable as well in terms of like what is payouts and everything. So it's not likely that it will fall because it is like literally a core pillar of Australia. And for demographic play, it is pretty okay to me. Yeah, I mean, I'm not looking towards, maybe not now, maybe in the future or whatever, but I'm not looking towards buying properties in Australia at the moment. So in terms of equities wise, I'm just looking for like the stable and good paying Australian stocks for the moment.
Okay. Thanks for sharing. Question for you. What is YCX background? Is he doing YouTube also? Sometimes see people argue against him. I think he shows true knowledge and make those looks really bad. Up to you, how much you want to share? I'll leave it to you.
Background in anyhow reading, I guess. I read a lot. I really read a lot, and I have interest in economics, finance, and computing sectors. So, and I guess games as well. I think games are a good way to learn about a lot of scenarios. So these four areas are, I mean, I also look at things like politics, all these as well. So it's about understanding incentives and all these areas. Economics is particularly a lot on incentives. So I read these areas more, and usually I read them as like, kind of like, I find it fun to read them because, so I guess it's kind of like a hobby to read.
I guess, don't know, let's say those who, but I don't, okay, this question is about like, is he doing YouTube? Also, I don't think YCX you are doing YouTube, right? But let's say, for those who interested to find out more, maybe you can join the YCX Telegram group or Meow group. We can ask more questions that maybe he is able to share more there. So so thanks for sharing on this. Let me cover the rest of the questions. Few more, then we want to go for lunch already. If we want to go TCSS live, is it we have to show our face to everyone on YouTube? So for those who are watching this on YouTube, right? We do this on Zoom. So it is a recorded Zoom session. Usually I will share the Zoom invite link in my Telegram group. So there's a Zoom link, you click into it. And usually before I set up the schedule, I will always tell beforehand that there will be a session. Usually we do it on Sunday, 10:30 in the morning. Nowadays, I don't do it every week. I think because last time there's a few weeks that I don't see that there's a lot of questions that coming in. So sometimes also we log in, cover 2 or 3 questions, then that's it, right? That's one reason. Second reason is also getting more busy nowadays. So I really scale down in terms of my video, but still try to do, let's say, like every month, at least we'll have one, probably 2 if I'm free. So I'll just join the Telegram group. Then you get to see when we have this session. Before that, I will send the Slido just for those who are interested to ask questions. They can ask the question. Or if you join live, also there's QR code on the left. You can just type up your questions there, right? Or even just unmute yourself and speak, right? You don't have to turn on your webcam if you don't want to show your face. You can just show up as let's just unmute and make your comment. And let's say if you make some comment and you don't want it to be public, just let me know. I can edit out. So but if I would prefer that you inform beforehand, like I say, okay, let's have this discussion, but I'm not comfortable to be public. Just want to join in and discuss, right? We can always have that discussion, and I would just don't post the entire video. It's also possible, or I just edit out, depending on the situations. So always welcome discussion on any forms of topic related to investing. So the purpose of having all this is just really sharing, let people learn, and usually we also need to put our ideas publicly, put it out, right? So that people can challenge, and people, sometimes I create video or share my thoughts, also people come and tell me where I'm wrong. I think that's also useful, because sometimes if you keep the knowledge to yourself, you don't even know if it is wrong, right? So that's the downside of keeping too much things private on yourself. So I prefer to publicly voicing my opinions. Feel free to come and challenge me and debate. Always enjoy this kind of discussions. So that's on TCSS. Next question. How is bagholder differ from TCSS? Who are 3 others? Is it good? I never click, as usually this kind of funny face, the content is lousy. TCSS honest face cover. The other 3 people, right, for those who didn't watch, right, the bagholder pod, right, the other 3 persons is Kelvin from Kelvin Learn Investing, then Eric, and also Chikeng. So actually, all of us, we have our own channel. It's just that for Eric, he already private his videos, and now he's on TikTok. So he's even more advanced compared to the 3 of us. So I think the key difference is that for TCSS, right, is really like for me to show up during the weekend. We almost have no time limit to discuss. Like you see, we have already started for how many, to 2.5 hours. We are still going, right? So there's no time limit. I can go on if there's any interesting discussion. But that also means that the video is very long. It's like 2 hours long video. I don't expect people to go and watch all the sections. That's why I usually have timestamp for you to help out to skip the section that you don't want to listen to, right? So you can do that, or you can listen to the recording whenever you like. So it's up to you. And I know that in terms of the view, it's also much lower. Like probably I get like 300 views per video, right? To me, not so important, because the more important one is just to have this kind of like sharing, discussion, debate. Then at least I enjoy the session. I'm just continue to do it. It's not like there's no monetary things involved here. Whereas for bagholder pod, I would say it will be more engaging, because we have like 3 or 4 people. Sometimes we have guests, all of us showing our video feed. So and we need to keep our time how to say, keep it like within a limit. Like I can't dominate the entire session. It will be becoming too boring, right? So everyone will have to, have sufficient time to voice their opinions. And then we are quite fast, right? It's just like when we cover certain topics, sometimes it's just like 15, 20 minutes, then we move on already. But the good part is that you will see like 3 or 4 people's like chatting with the video on. So it's not going to be as solo as TCSS. So the TCSS is more like for me to put on my personal channel, so I can do however I like. Whereas for the bagholder pod, I think it's more organized. Like there's more preparations, and it's shorter in terms of the content length. And you get to hear opinions from like 4 different people instead of like just usually TCSS. Mainly I'm the main person, and I'm grateful to have YCX here to help out with me to answer the questions. But it could be quite solo and quite boring. I agree on that. So that's on the difference. And on the face things, right? I think that's how it is, right? If you don't put in some funny face, right, sometimes you don't get as much views. So and we need to get the views in order for the entire channel to work, because you need to understand that for people's like Kelvin, right? He is full-time YouTuber. You ask him to spend the time to do the bagholder pod. There's the cost to it now. It's like he could just spend the time to do his own video and he can earn some money on that, right? But he's spending time on this bagholder pod. So we need to do some things that is like attracting views in order for the pod to earn some revenue, in order for the entire things to be viable. If not, right, if we don't do these kind of things, we get very little view, then there's no revenue for bagholders. Then what happens is that we just have to close down the channels, because it doesn't make sense for people like Kelvin, who is working full-time as a content creator. I'll just say that. Hope you understand why there's this funny face there. Okay, for my own channel, I don't care. I don't care. I care more about the sharing part. Like if people don't watch, then I don't really care. Okay. That's on me. Any comment on anyone who's like listening live here? You want to give your opinion on this? Any suggestion for me to do differently? Anything? Okay. If not, let's move on. Do you notice Twitter recently feeds so many from those I don't follow? How to setting in the past only show those I follow? This one is a change in terms of their algorithm. I think not just Twitter, even Instagram also, they make similar changes. Is that if you just based on your recommendations, right, they will actually push those posts or feeds that's from people that you don't follow. So that's their recommendations works. But it's very easy because I'm not sure whether you noticed this before, right? So this is your feeds, right? It looks like this, right? I think by default, they will show you this one for you. This is basically their recommendations. And this one, they will show some portions from those people that you follow, and also a portion from those that you don't follow. So this is the default. But you can always swipe to the right or left, depending on how you call it, I don't know. You go to this following tab, right? This following tab will be the one that only you follow. People that you don't follow, it won't flow into this following. So it is quite simple, just a swipe. So in case you don't know. So that's it. That's the trick. And you follow me. Thanks a lot. Yes, I still try to post some useful stuff on Twitter. But sometimes depends on my schedule. If I'm busy, sometimes I'm quiet on Twitter. But it's quite interesting. Twitter also you can like respond, discuss. I think it's quite engaging sometimes, depending on how you use it. Yeah, some people use Twitter just to consume information that you don't share as much, right? You don't discuss things with people. So it will give you different type of experience depending on how you use the apps. So I'll share that now. Hi Boon Tee, last time you recommend Avast free virus, try install, but a lot of adverts keep asking you to sign up. You got other recommendations? Yeah, I do agree on this. Free stuff is like really right. So sometimes you pop up some warning to say you are vulnerable to virus. Please upgrade to premium and make payments, right? So this is what we call the freemium models. Yes, on the free tier, they give you some basic protection, but of course they will find ways to try to attract you to sign up to get the premium, to get more stuff, right? So that's why it's freemium models. For me, I'm still continue to use this Avast free virus. To me, I'm fine. I don't care about the upgrading. If they prompt me to upgrade, I just like ignore them. That's how I use it now. For others, I really don't know. Is there any other antivirus software that give you good basic protection at the same time don't push all these ads to you? I don't have other recommendations. Probably you might just want to pay some small money and just get a paid one. Probably better also, right? I don't know. Maybe less ads, depending on what you want. I'm not expert in this area. I'm just sharing what I've been using. So I don't know others, YCX or others, you have any other recommendations?
No, the antivirus is, to me, I just do my own stuff. That's all. It's a acquired thing. Yeah.
Okay, you're much more advanced lah. I think this one is more like for those who are like beginner noobs lah. I'm noobs when it comes to all this lah. So I'll be using this. At least I think at least it's better than no antivirus. That's the only thing that I'm thinking.
I think Windows Defender is enough.
Yeah, that's true also. You're not using anything also. As long as you don't go to like those fishy sites, I think the risk isn't super high one. And you are not targeted. People don't target you specifically. I think it's fine one. Yeah. So
I think the other better way would be to have two computers and one computer only for your financial things and the other computer for whatever nonsense. So that is how I would suggest, if you really want to skip all this headache, just do that. Just have two computers, one for finance and important things, and the other for everything else.
Yeah, that is a lot safer compared to whatever antivirus that you have. Okay, last question is, what do you think of Goldman Sachs pushing back Apple partnership? Actually, I just saw this news on Wall Street Journal. Luckily, I saw that news. If not, I don't even know what is GS here. So actually, for context, is that this is about I think those fintech stuff that Apple is doing. For example, like the Apple Card. Back end, they need to partner with banks in order to do bank things, right? Like the buy now, pay later things that they've been doing with Goldman Sachs. And they have some, like high saving account also, right? Also with Goldman Sachs, right? So I think this is the partnership has been ongoing for a number of years already, since Apple come up with Apple Pay. So I think they've been in this for some time, but Goldman Sachs seems like they want to pull out and they want to sell this partnership to American Express. That is what I've been reading on the news. The question is why they want to pull out, right? I think based on the news is that they want to they want to, how to say, they want to exit their consumer business lah, which means they want to focus just on the investment banking lah. That's my take on that. I think it's mainly like this is not an area that is super profitable to them. I saw in that news article, it says that this entire consumer or consumer business, right, is still losing money. That's why they might want to scale back on that front. That's my surface take on this. I actually don't have much insight on these things. And also I think you also need to think that these things, right, still new. This entire Apple Goldman Sachs partnership, try to do something on the fintech side, right? Still new. You also need to think that, let's say, call it like 3-5 years ahead, right? If this entire arm become a lot bigger, who actually has the power to dictate the directions of the business? My experience tell me is that when Apple do these kind of things, right, they actually they are quite control freak in a way. So I would say Apple probably has more control as compared to Goldman Sachs. That's why, let's say, even if you become big in terms of how much they can milk from this entire thing, right, probably it will be more like a commodities from Goldman Sachs perspective, and Apple might actually like benefit most from these things. So that's why they might think that, okay, they could be still like losing money now. Even it become profitable, they are not the one that milking it. It probably is the Apple that's milking it. So probably this kind of situations. So that makes them want to push back or want to exit from this business. Or they, for Goldman Sachs, right, the other piece of business, which is their all the investment banking, those are really like super high margin business, right? So they might just want to focus on those, right? The other parts, the consumer banking, I don't think it's in their DNA. So that's my very surface look onto this by just reading one article. You probably want to like cross-check with other points and need to wait for some time to see how it play out, to see what was the actual situations, right? So I'm just guessing here. Any other guess? Any other people want to, contribute your view on this?
I think there was like some reports on like the Federal Reserve, the federal side. I'm not sure is it FDIC or Federal Reserve, right? They did they did like an assessment on like the banks, and like because the banks had to do their own risk reports, right, to model like the things. So then they I think Goldman Sachs in particular, they put a lot of risk on like on the credit cards, right, and non-payments. Yeah. So I think they are very conservative in terms of like this kind of credit cards things, because the probably is pretty high risk according to them. Compared to other banks, they put credit cards as pretty high risk. So that is one thing. Maybe they are just trying to de-risk it or something in that thing. Yeah, I mean, I'm not entirely sure as well, but this could be one of their reasons to reduce risk. Yeah.
Okay. Thanks for the sharing. Okay, I have to say thanks a lot to YCX for co-hosting this together. And I think this is like probably the longest episode that we will have. We will see, could maybe close to 3 hours recording. Thanks a lot for all the sharing and all the insights. Really, really grateful on that. I will close the call here and post the recording later. And thanks for everyone watching this.